Greetings, everybody. Welcome to Liberty Call. Today is January 4th, 2022. Hope everybody's having a fantastic day out there. Pretty good day here in the markets. Looks like everyone reacted fairly well to the Fed minutes that came out today and digested that information. Market was up by more than where it closed out, but certainly finished the day in positive territory, because I know the Dow went into the red for a little bit, but not for too long. So, all right, well, let's go ahead and, let me stop. If it's your first time watching, give me some thumbs up, likes, shares, subscribes. I'd greatly appreciate it. And let's go ahead and jump into the numbers. The Dow Jones finished the day up 0.4%, or 133 points at 33,269. The S&P 500 was up 0.74, closed at 3852. NASDAQ was up 0.69, closed at 10,458. Let's see here. Small caps are up by 1.46. The VIX fell 4.06 today. It's currently at 2197. Canada was up 0.75. Brazil was up 1.07. Mexico up 2.22%. Over in Europe, lots of green there too. Germany was up 2.18. UK up 0.41. France up 2.3. The Euro Stoxx up 2.36. Netherlands up 1.4. Italy was up 1.74, Switzerland up 1.47, and Portugal closed out Europe with being up 0.64. In the Russian markets, both red there. The MOX was down 0.2, the RTSI down 1.37%. And looks like mostly green in the overnights in Asia. Japan was down 1.45, Australia up 1.63. In China, the Shanghai was up 0.22, the SCSE component down 0.2, China A50 up 0.25%, DJ Shanghai up 0.2, and the Hang Seng up 3.22. Taiwan weighted came in down 0.18. So for most of trading day, January 4th, it looked pretty good across most of the markets. So we'll take that as a win. But again, like I've been saying, we got a long way to go before we get things get a whole lot better. So, all right. Let's go ahead and go through today's market recap. S&P 500 climbs in wild trading after Fed minutes point to higher for longer rates. And again, if you've been watching this on a regular basis, you know that the financial journalists and the people out there in the financial world have just been chomping at the bit to start lowering interest rates already. And it's like, maybe we should wait till the inflation gets fixed before you start counting your chickens before they hatch. But, again, these folks just are nuts. All right. The S&P 500 climbed Wednesday, but investors had to contend with wild swings as the Federal Reserve December meeting minutes signaled higher for longer rates ahead at a time when data showing a tight labor market stoked fears of a pickup in inflation. Federal Reserve policymakers agreed that a sustained period of restrictive policy would be needed to cool, quote, unacceptably high, end quote, inflation, according to the minutes of the Fed's December meeting released on Wednesday. The U.S. Labor Department U.S. Labor Department's latest job openings and labor turnover survey, the JOLTS report, a measure of labor demand, showed job openings in November fell less than expected to about 10.5 million, compared with expectations of 10 million. The JOLTS report was, quote, very strong, Jeffrey said in a note, warning that without a substantial reduction in labor demand, the Fed will not be comfortable pausing, let alone cutting rates, end quote. U.S. Treasury yields, however, continued to trade in the red and were reluctant to price in more aggressive Federal Reserve rate hikes. Banking stocks, however, shrugged off the fall in Treasury yields, the enemy of net interest margins, as investors looked ahead to the start of quarterly earnings season in earnest next week. Quote, Q4 earnings should be decent for most banks, in our view, with higher rates and solid loan growth continuing to benefit net interest income in the near term, but positive momentum may start to fade, end quote, Wedbush said in a note. Citigroup, SVB Financial Group, Zions Bank Corp led gainers in financials. In consumer discretionary, Tesla climbed nearly 5%, following a 12% plunge the day earlier, while Bath & Body Works jumped 9%, following a price upgrade to $52 from $50 from Piper Sandler. Travel and leisure stocks were also in focus as cruise stocks rallied after Carnival said it would raise its price for U.S. and European guests starting April 1st. Carnival Corporation was up 9%, while Royal Caribbean Cruises and Norwegian Cruise Lines were up more than 7% and 4%, respectively. Microsoft Corporation, meanwhile, fell about 5% after UBS downgraded the stock from neutral to neutral from buy, citing demand demand headwinds for the company's office and cloud businesses. A Micron-led surge in semiconductor stocks helped keep a lid on downside momentum in tech. Micron Technology rallied 7% after Daiwa talked up the prospect of higher memory prices on expectations for a rebound in demand in the second half of this year. All right. So looks like some folks are thinking that quarterly earnings are going to look pretty good. We shall see when those do come out in the upcoming weeks. All right, next article up has to do with the Fed minutes that came out. Fed backs higher for longer rates to tackle unacceptably high inflation. Federal Reserve policymakers agreed that a sustained period of restrictive policy would be needed to cool unacceptably high inflation, according to the minutes of the Fed's December meeting released on Wednesday. Quote, participants generally observed that maintaining a restrictive policy stance for a sustained period until inflation is clearly on a path towards 2% is appropriate from a risk management perspective, end quote, the Fed's minutes showed. At the conclusion of the previous meeting on December 14th, the FOMC raised its benchmark rate by 0.5% to a range of 4.25 to 4.5. The Fed's policy decision in December marked a slowdown from 4 consecutive 0.75% rate increases seen at the prior meetings. Despite a willingness to move at a slower pace of hikes, Fed members at the meeting backed the need to raise interest rates further, upgrading their forecasts on the peak level of rates or the terminal rate. Members viewed that a higher for longer rate regime would keep a lid on economic growth and curb inflation, which remains unacceptably high, according to the minutes. At the meeting, Fed members estimated a median rate of 5.1 in 2023, up from a prior forecast of 4.6%, suggesting a target range of 5 to 5.25, or about another 75 basis points of rate hikes ahead. Again, my personal guesstimate would probably be somewhere over 6%, but I guess you could go slower and hope that inflation trickles along, slows down quick, or in my opinion, will slow down slower. But we're just going to wind up dragging this out as long as possible. I would like to see rates get jacked up as fast as possible, cool the economy. Yeah, you're going to have some collateral damage, but who can we blame for this? The Federal Reserve, who we're talking about right now. They printed all this money, created all this inflation, and then stood there with their hands in their pockets, like, well, I don't understand what's going on. So. All right. Debate among Fed members continued to focus on two risks: the risk of pausing too early, which would threaten the central bank's aim of bringing inflation down to its 2% target, and the risk of tightening too much, pushing the economy into recession. Again, I would probably say we're already in a recession, just no one wants to talk about it. Quote, many participants highlighted that the committee needed to continue to balance two risks. One risk was that insufficiently restrictive monetary policy could cause inflation to remain above the committee's target for longer than anticipated, leading to unanchored inflation expectations. Well, so inflation would remain above the committee's target for longer. Do they have a target for how long it's going to take right now? I mean, I haven't really seen anyone say, well, we think inflation will go down in April. These people are just shooting from the hip, and people think that they're really have a clue what they're doing. But anyways, let's see here. The other risk was that lagged cumulative effects of policy tightening could end up being more restrictive than is necessary to bring down inflation to 2%. So they think they're going to be too restrictive in the economy, and it's going to cause a lot of problems. Well, I hate to break it to you, you've already caused all these problems, so you might as well just get it fixed. Ultimately, the committee members, however, continued to view inflation outlook as a, quote, key factor shaping the outlook for policy, end quote, the minute showed. Earlier on Wednesday, Minneapolis Fed Reserve President Neil Kashkari said that there were signs of easing inflation. The Fed still has more work to do. Quote, it will be appropriate to continue to raise rates at least at the next few meetings until we are confident inflation has peaked, Kashkari said, forecasting a Fed pause at about 5.4%. Quote, I have us pausing at 5.4%, Kashkari said, though added that any risk to inflation remaining higher for longer will, quote, warrant, in my view, taking the policy rate potentially much higher, end quote. The latest data pointing to a still tight labor market, which threatens to fuel wage growth and inflation, outlined the need for the Fed to continue tightening monetary policy. U.S. job openings, a gauge of labor demand, fell less than expected in November to 10.458 million from 10.512 million in October, according to the Bureau of Labor Statistics. Quote, the JOLTS report was very strong, showing us no improvement in the labor imbalance, end quote, Jeffrey said in a note. Quote, without substantial reduction in labor demand, the Fed will not be comfortable pausing, let alone cutting rates, end quote. Fed members expect, however, that under an appropriately restrictive path of monetary policy, labor market supply and demand would come into better balance over time, easing upward pressures on nominal wages and prices, the minutes showed. About 84% of traders expect the Fed to lift rates by 0.25% at its next Fed meeting on February 1st, according to investing.com's Fed Rate Monitor tool. Quote, we expect 3 additional 25 basis point rate hikes in February, March, and May for a fund peak rate at 5 to 5.25%, Goldman Sachs said in a recent note ahead of the FOMC minutes. Again, I think it's got to go higher. I don't think the inflation, I mean, this is some stubborn inflation. And, just looking back historically of, what the Fed had done in previous, situations where inflation was as high as it is, they actually had to go above the inflation rate to actually start bringing that down. And sometimes it took more than one attempt to actually get that to work, like in the early 80s. So again, I don't think they can just wave their magic wand and everything's going to fall back into place. But again, I could be wrong. All right. One last article sort of has to do with the Fed. This comes from Mises Wire, written by Ryan McMacken. Money supply growth turns negative for the first time in 28 years. And for those who have heard me rail about what the Fed's done the last few years, seeing the money supply shrink a little bit is actually some welcome news. Money supply growth fell again in November, and this time it turned negative for the first time in 28 years. November's drop continues a steep downward trend from the unprecedented highs experienced during much of the past 2 years. During the 13 months between April 2020 and April 2021, money supply growth in the United States often climbed above a 35% year over year, well above even the high levels experienced in 2009 to 2013. Since then, the money supply growth has slowed quickly, and we're now seeing for the first time the money supply has actually contracted since the 1990s. The last time the year over year change in the money supply slipped into negative territory was in November of 1994. At that time, negative growth continued for 15 months, finally turning positive again in January of 96. During November of 2022, year-over-year growth in the money supply was at a negative 0.28%. That's down from October's rate of 2.59% and down from November 2021's rate of 6.66%. Money supply growth can often be a helpful measure of economic activity and an indicator of coming recessions. During periods of economic boom, money supply tends to grow quickly as commercial banks make more loans. Recessions, on the other hand, tend to be preceded by slowing rates of money supply growth. However, money supply growth tends to begin growing again before the onset of the recession. Another indicator of recession appears in the form of the gap between M2 and TMS. The TMS growth rate typically climbs and becomes larger than the M2 growth rate in early months of a recession. This occurred in the early months of 2001 and the 2007 to 2009 recession. A similar pattern appeared before the 2020 recession. Notably, this has happened again beginning in May this year, as the M2 growth rate fell below the TMS growth rate for the first time since 2020. Put another way, when the difference between M2 and TMS moves from positive number to a negative number, that's a fairly reliable indicator that the economy has entered into recession. And we can see that here in this graph right here. Interestingly, this indicator also appears to follow a pattern of yield curve inversion. For example, the 2 to 10-year yield inversion went negative in all of the same periods where M2 to TMS gap pointed to a recession. Moreover, the 2 to 10-year inversion also fell into negative territory in 1998. This is not surprising because trends in money supply growth have long appeared to be connected to the shape of the yield curve. As Bob Murphy notes in his book, Understanding Money Mechanics, a sustained decline in TMS growth often reflects spikes in short-term yields, which can fuel a flattening or inverted yield curve. It's not especially a mystery as to why short-term rates are headed up fast and why the money supply is decelerating. Since January of 2022, the Fed has raised target federal funds rate from 0.25% up to 4%. This means fewer injections of Fed money into the market through open market operations. Moreover, although it has done very little to sizably reduce the size of its portfolio, the Fed has nonetheless stopped adding to its portfolio through quantitative easing and allowed a small amount, about $358 billion out of $8.9 trillion, to roll off. Yeah, again, that's something that I follow up with clients a lot, showing them, how much the Fed balance sheet, rate increases and such, and and the M2, and the Fed hasn't done a whole lot of getting rid of the assets on their balance sheet while they've been raising rates over the last year. Diving back in, it should be emphasized that it is not necessarily for money supply growth to turn negative in order to trigger recession, defaults, and other economic disruptions. With decades marked by the Greenspan put, financial repression, and other forms of easy money, the Federal Reserve has inflated a number of bubbles and zombie enterprises that now rely on nearly constant infusions of new money to stay afloat. For many of these bubble industries, all that is necessary is a slowing in the money supply growth brought on by rising interest rates or a confidence crisis. Thus, a growth rate in the money supply turning negative is not in itself an especially meaningful metric, but the drop in negative territory does help illustrate just how far and how rapidly money supply growth has fallen in recent months. This is generally a red flag for economic growth and employment. It also serves as just one more indicator that the so-called soft landing promised by the Federal Reserve is unlikely to ever be a reality. So, and I would 100% agree with that. I think we're going to come crashing into the ocean and the airplane is going to fall apart. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com, and I hope everyone has a fantastical evening, and I will talk to you next time. Bye-bye.